Hi guys, this is Tal the Lord of Informed Trades, and basically what I'm doing now is just testing out my capabilities of making videos, and I thought I'd share a few thoughts about reading charts. So what we have here is basically the Euro USD. It's a 5-minute chart, intraday standard stuff, and I'd like to basically discuss one common mistake, which is looking at a chart like this. Um, I think it's bad to look at this. This is just really short and condensed. And basically, what are we seeing here? We've had this little up movement, and someone might have called this the short. Would have taken a nice move. And then what would you do here? You'd go flat or up or down. You're looking for a breakout. And just looking here, um, has good information with price action, but you can get much more by doing this one really simple trick that I like a lot, and it's just squeezing that chart. Oh my god, look at that. It's a completely different picture, isn't it? So basically what I did is just squeezed in, I squeezed it down to as small as possible, and then instead of seeing like 20 bars or whatever, we've got, how much is that? That's 28th, that's 18th of January to 21, so that's 3 days of 5-minute bars. I actually did the calculation, comes out to 1,700 and something individual candles that we're seeing here. It's a lot of information, and I think the advantage of that, or why I like to look at charts like this, is it because it lets you know what's going on. And so the first thing that this guy screams at us, this chart screams at us, is down. It's a nice bearish market. Look at those movements. Let me clear out that volume. I'll talk about that in a minute. Um, yeah, look at that. That just boom, boom, boom. It's been going down, and we could raise time frames, and we've got even higher, even more down movement. Look at that. That's more than 1,000 pips at this point. Since when is this? 30th November or so. 1,000 pips is a lot. So what we're seeing is a strong down movement, and then if we look even at just a smaller piece, what we didn't see before when we're looking just to this area, we see this little double bottom here. And we see this big spike, which we only saw a piece of, and we kind of get the context of the support that it broke here, support that it broke here, and it got rejected. Exactly where it's playing now. Look, this is where the price is. It's relevant to this area over here, which we had yesterday. And suddenly we just get a much bigger picture. So what I'm trying to show in this video is basically a common mistake, in my opinion, that traders make, and something that I did a lot of, is just sitting all day in front of this and looking at the bar as it develops. And that's great if you're scalping. If you're making very quick in and out trades, I think it's much easier to trade, at least starting from this time frame, to get an idea of what's going in the market. Again, you can see a very well-defined downtrend, and you can see this double bottom, and then you can expect, I don't know, if you're a double bottom kind of guy, then you'd expect the market to shoot up, which it did. Otherwise, you'd say let's stay in the trend. And if we're in the matter of double bottoms, and one of my major trading paradigms I'd like to share with you at the moment is that double bottoms don't stop a downtrend, and double tops don't stop an uptrend. And this is one of those rare moments where I believe it's all about the smart money. And I guess this isn't as tested on Forex. I've never looked at it in Forex before, but trading the S&Ps, the futures, and other stocks, basically double bottoms. A lot of retail guys are going to go long here. Let's look at that a bit zoomed. And basically, a lot of guys probably went long around here, and it went great for them. That was like a 100-pip move. Whoever got out here, made a nice chunk of change. And I'm sure a lot of people will look at this double bottom and say, that's the end of that downtrend. That 1,000 pips that we went down, this double bottom's going to break it. And that means that we're going to have a lot of stops here. And while I'm not a big believer in stop hunting or market manipulation, this is kind of, well, let's say on the futures, this is something I'd go short just because of this. Just because I'd be sure 100% that there's there's almost a guarantee that there are stops here in abundance. And I'd expect the market to get pushed down. Then basically what would happen is the market would get pushed down. When the stops get triggered, the guys that sold up here are going to trigger stops from the buyers. The buyers, their stop is a sell. And these guys excuse me. Yeah, these guys, the guys that went short, want to buy. So suddenly they're gonna synthetically create sellers for their buying position by pushing the market down here. They've actually kind of synthetically created a market for themselves, and their profit would be everything in between here and here, in between here and there. So you know what? I'd sell even more. I'll probably do it on my live account. And again, this was just a test, so I hope this video works out. And that's it. Thanks for watching, guys. Bye.